Welcome to the CFA Level 1 exam questions and answer video series. The previous video was the video number 3 on the topic of cost of capital. Today we'll continue on the same topic. In the last video we finished 10 questions. Today we'll have question number 11 and 12. They are a little bit longer and more complicated than the previous ones. As I said, we will start with the question number 11. A company has the following capital structure: 30% debt, 20% preferred stock, and 50% common equity. So these are the weights that I'm going to use to calculate the weighted average cost of capital. And all I need is the cost of each component of this financing. The debt component has cost. That cost will be multiplied by 30%, and the cost of preferred stock by 20%, and the cost of equity by 50%, and then we add them together, we get the weighted average cost of capital. The tax rate will be used with the debt because tax only affects the debt and it provides tax shield to the debt holder, and it has nothing to do with the preferred stock nor the common equity. The firm can issue 1,000 face value 7% semi-annual coupon debt with a 15-year maturity for a price of this much. So we pay twice a year. That means 7% twice a year. That means in 15 years I will pay 30 times. Each year I will pay 2 times. And this is the net present value of all these payments, including the 1,000 face value that will be paid by the end of year 15. So that will help calculate the rate at which the net present value of 1,047 paid today will be exactly $1,000 at the end of 15 years. So this is the IRR calculation. We'll see it in Excel. Preferred stock issue that pays dividend of $2.8 and has a value of 35. This is a direct calculation. 2.8 divided 35. This will be the return to the investor in our preferred stock, and it will be the cost of the preferred stock to the company. The company's growth rate is estimated at 6%, and the company's common shares is selling for $40 but pays $3 today as dividend. So dividend growth model will be used to calculate the cost of equity because we don't have complete data to use the capital asset pricing model to calculate the cost of equity, which is a normal way because we don't have beta here. So I cannot use the the capital asset pricing model. Instead, I will use Gordon growth model, dividend model. We will see that in a minute. So the question definitely about the weighted average cost of capital, and these are the answer givens. So how to calculate the weighted average cost of capital? As I just mentioned, we multiply the weight by the cost of each component. Let's bring in the formula. Equity divide both equity and debt will give the weight of equity time return required by equity holder, the weight of debt time return required by the debt holder time the tax shield, plus in our case the preferred stock will come into play, plus the weight time the cost. Let us start with the cost of debt, which is 6.5 time tax shield will give this figure. But from where we got this 6.5%? This is the rate at which discounting this figure today after 15 years will give a base value of $1,000. Let us see that in Excel sheet how to calculate this. So this is the information given in the question. The firm can issue 1,000 face value and 7% semi-annual payment for 15 years maturity. This is the way we calculate it. Year 0 until year 30, or the 30 payment The cash flow in year 0 is simply a negative cash flow of 1,047.46. That is this figure. The investor will pay today cash outflow negative of this much. What in return is going to get is 1,000, the face value, times 0.07 divide 2, because we pay twice every 6 months. So this is what is being paid every 6 months until the last year. In the last year, we will add the face value, which will be paid back to the investor. So in the last payment, the investor will receive 1,000 plus the interest due on that day. So the rate we are looking for is simple, the IRR for all these cash in and out, a rate at which we get the value of 0, which equate to these figures. Let us see how much we get. So 3.25 times 2, because this is semi-annual, this is the 6%, 6.5, which we have seen in the answer to the question. As we have just seen in the Excel sheet, it is 6.5%, which is the cost of debt. We are going to use here cost of debt times the weight of the debt, which is 30%, times 1 minus tax shield, which is 35%. So this part of the equation is over. Let us move on to the cost of preferred stock. As I just mentioned, it is what they get in dividend, divide the price, which is 8%, and this is straightforward. And now we are going to move to equity cost. Normally equity cost is used, we use the capital asset pricing model, but now the data given will help with the growth model of dividend growth model to calculate the net present value of the price at which will give us the current price. Let us see how we do it. Dividend next year times 1 equal dividend today at time 0 times 1 plus growth of 6%. The company's growth rate is estimated to be 6%. Growth in dividend, if we pay $3 this year, next year will be 1 plus 6%, which is 3 times 1 plus growth, which is 6%. That will give us next year dividend is this much. We should use the same logic, 2.8 divide 35, which we did here with the preferred stock, but we have growth. We will do the same, but we will add the growth factor. So 3.18 divide 40 plus the growth will give the cost of equity. So 3.18 divide 40 plus the growth. That is the difference. So we will use 13.95 cost of equity. Now we have the 3 costs, 4.22 times 30%, 8% times 20%, 13.95 times 50% will give us the weighted average cost of capital. This is the cost of equity which we've just calculated. Time the weight of the equity. Weighted average cost of capital is 30 times 42, 20 preferred times 8%, and 50% times the equity. This will give us a figure of 9.84, and A is the right answer. Let's move on to the question number 12, the final question. An analyst gathers the following data. We have the capital structure and the required rate of return of each component in the capital structure. The first one is debt, represents 30% weight, and it costs the company 10%. Preferred stock, 20% weight and 11% cost, and 50% common, 18% cost of equity. If we have the tax, we will multiply the 10% by the tax and get the figure. assuming 40% tax rate, what after tax rate the company earn on its investment. So these are the figures. Let us do the numbers. It's a direct answer. I think it's straightforward. Each weight by the cost, 30%, 10%, y minus 40%. So here we have 20% times 11%, 50% times 18%, the total is 13%, and definitely this is the answer. With this, I think we come to the end of the video number 3. Please do subscribe to this channel so that you receive all the series